So what happens when a booming, multi-billion-dollar industry suddenly discovers its entire foundation is basically a house of cards? Today, we're going to dive into the world of global airport duty-free, where a hidden dependency created a massive, unforeseen risk. And trust me, it's a huge lesson for any business out there that thinks just growing is enough to be secure. Let's start with a question that kind of flips a core business belief right on its head. For years, the mantra was always more is better. More traffic, more customers, more growth. But what if that simple equation was dangerously incomplete? What if focusing only on growth was actually hiding a fatal flaw? All right, so here's our game plan. First, we'll look at the old growth formula that seemed to work so well for so long. Then, we're going to peel back the layers to see the risky concentration it was hiding. After that, we'll get into the new way of thinking, what we're calling the resilience revolution, and we'll even look at a formula to measure your risk. And finally, we'll wrap up with why diversification is now the key to building a resilient future. Okay, let's kick things off with part one, the old growth formula. For about a decade, the entire global duty-free industry was running on one simple, powerful, and as it turns out, deeply flawed belief. And this was it. This was the golden rule. The logic seemed totally rock solid, right? More people walking through the airport simply equals more sales. It's simple, it's easy to track, and for a long time, it looked like it was working perfectly. But here's the twist. The growth you could see on the surface was being held up by a hidden dependency. It was just like an iceberg. All the real danger, that massive concentration of risk, was lurking just beneath the surface, completely out of sight. So, let's actually look at the numbers. This brings us to section 2, a concentrated reality. And this is where we're going to see just how shaky that foundation really was. Wow. Okay, this chart really shows the scale of the problem. Before 2020, the Asia-Pacific region alone was driving nearly half of all global duty-free sales, a whopping 45%. When one single region is that dominant, your entire business is anchored to its stability. That's a huge structural risk, just hiding there in plain sight. And if we zoom in from regions to nationalities, the picture gets even sharper. So this index, it benchmarks Chinese travelers at a perfect 100. But look at the incredible spending power from travelers from places like the UAE and India as well. The really crucial point here is that it wasn't just about the number of people. It was about the spending habits of a few specific groups driving that massive regional number. So let's just put it all together. The global revenue stream was being fed by just a few gigantic funnels. We're talking nearly half your income from one region, driven by a small group of super high-spending nationalities. The implication, though a lot of people missed it, was pretty stark. The industry was dangerously over-reliant on a very specific customer base. Well, this realization forced a massive strategic shift, which brings us to our third section, the resilience revolution. The industry had to pivot, and pivot hard. It was time to stop just counting heads and start understanding the value of those passengers. And this slide just lays out the change perfectly. The old model was basically a big, kind of dumb funnel. Just pour more people in the top, get more revenue out the bottom. The new model, though, it's much more like a microscope. It focuses on the quality of demand, analyzing the passenger mix, their spending habits, and the total value each group really brings to the table. And the results of this new approach, they're absolutely stunning. A full 56% of airports are now reporting commercial revenues that are higher than they were before 2020. And the really incredible part, they're doing this without even reaching those old passenger numbers. This is all the proof you need, right here. The key takeaway is that the quality of your customers now matters way more than the quantity. It is a fundamental shift in how to think about revenue and, well, resilience. So, if passenger mix is the new name of the game, how do you manage that risk? Well, welcome to section 4, measuring your exposure. We're going to introduce a formula that turns this abstract idea of risk into a concrete, actionable number. Okay, here it is, the revenue exposure formula. It might look a little technical, but it's actually super simple and incredibly powerful. You take the percentage of your duty-free revenue from a single nationality, and then you multiply it by something called a volatility index. Now, this volatility index is basically a score that reflects how stable or unstable a market is. Think of things like economic forecasts, political stability, currency swings. The higher the score, the more unpredictable that source of revenue is. Now let's see this thing in action. Just look at that top line for a second. Chinese travelers might be bringing in 35% of your revenue, but once you factor in the high volatility of that market, a 0.7 on the index, you suddenly realize this one group accounts for nearly a quarter of your total business risk. Now compare that to the UK. Lower revenue, yeah, but much lower volatility, resulting in a tiny 2% risk profile. See the difference? It's huge. So what does a number like 24.5% exposure actually mean in real dollars and cents? Let's run a quick stress test to see what that tangible damage really looks like. Okay, imagine just a 20% drop in spending from that one single high exposure group. The first hit, bam, right to the top line. In this model, that's an instant loss of $35 million in revenue. That is a massive blow caused by the instability of just one customer segment. But revenue is only half the story. To see the real damage, we have to look at profit. And let's assume a pretty standard 40% duty-free margin. And there it is. That revenue loss blows a $14 million hole directly in your bottom line. This is the exact moment when abstract risk stops being some theoretical idea on a spreadsheet and becomes a very real and very painful problem. So how do you protect your business from this kind of shock? Well, the answer lies in our final section, the diversification imperative. The goal is to move from a concentrated high-risk model to one that is balanced, spread out, and genuinely resilient. And this slide right here, this shows the strategic goal perfectly. By spreading out your revenue sources across multiple regions, no single customer group accounts for more than, say, 15% of your risk. The entire business just becomes structurally sound. It's supported by multiple stable pillars instead of wobbling on a single point of failure. So how is this actually done? Well, airports are using 4 key strategies. First, they're designing airline routes to attract new high-value markets. Second, they're aligning their product mix to what these new customers actually want to buy. Third, they're using data segmentation to pinpoint exactly who to target. And finally, they're building partnerships to create a totally seamless customer experience. Really, it's just applying modern portfolio management theory directly to airport commerce. And that leaves us with one last and I think really important question for any business leader out there. After seeing how a hidden dependency can create such a massive risk, you have to take a hard look at your own strategy. Is your business built just to chase volume, or is it truly built for resilience?